Okay, dear students, first of all, welcome to FR Crash Course. And today's class, we are starting from IFRS 5, and I'll be giving you first a recap of IFRS 5, and then we'll be doing question on this IFRS 5, non-current asset held for sale in discontinued operations. After IFRS 5, we'll go towards IAS 37, which is also in the today's agenda. Plus, then finally, we'll go for IAS 32. Initially, in the agenda, IAS 33 was also included, but due to, I think, time constraint, we will not be able to go for IAS 33 in today's class. But in upcoming class, don't worry at all. We'll go for IAS 33, inshallah. So let's just quickly revise IFRS 5 non-current asset held for sale. First of all, what is the criteria of IFRS 5? I'll come to that. But just one concept which you should have a very good understanding on that concept, and that concept is if XYZ, let's say ABC company, has applied IFRS 5. So after applying IFRS 5, what are the major changes in the financial statement which you will see? Number one, after applying IFRS 5, a non-current asset will be reclassified as current asset. Second, after applying IFRS 5, no depreciation. After applying IFRS 5, no depreciation. Third, asset will be measured at lower of carrying amount, and we'll compare carrying amount with the fair value less cost to sell, whichever is lower. These are the three major changes you will see once you have applied IFRS 5. So you can see one thing, that after applying IFRS 5, there are significant changes in your financial statements. That is why IFRS 5 has given us a proper criteria. If all the conditions which are mentioned in the criteria, if all the conditions are met, only then you can apply IFRS 5. Otherwise, you cannot apply IFRS 5. Let's see what are the conditions. A non-current a non-current asset should be classified as held for sale if its carrying amount will be recovered principally through a sale transaction. Rather than continuing use, reclassify non-current asset to current held for sale when the following criteria is met. Number one is asset must be available in its present condition. For example, you want to sell a property, plant and equipment. Okay, let's say your company has given an ad also, and assuming a potential buyer has visited to that plant, to that site, and that potential buyer, now that buyer really wants to buy that property, plant and equipment, and that buyer shows the interest that we are interested to buy this plant, and after listening this from the buyer, your company replies, or representative of your company replies, that right now on this plant we are running XYZ customers order, so right now we cannot sell this plant. The moment you inform that customer, right now that on this plant we are running XYZ customers order and we cannot sell the plant right now, it means IFRS 5 cannot be applied on that plant. Why? Because it is not saleable in its present condition. Another example could be, for example, you want to sell a building, okay? But before selling a building, the company has decided, let's do the renovation. People have just started the renovation, and during renovation, your company came to know that something is wrong with the foundation of that building, which needs a correction work. Of course, if you know something is wrong with the foundation of the building and you're not going to correct that thing, it means it's going to be dangerous for the buyer. Now, let's say during that time, even you get an offer from the buyer, you cannot, logically, your building is not in a saleable condition. Again, you cannot apply IFRS 5. So assets should be saleable in its present condition. The sale must be highly probable. The meaning of highly probable is after applying IFRS 5, your assets should be sold within 12 months. Management are committed to a plan to sell the asset. There should be a proper, I would say, commitment from the management. And obviously, that commitment can be seen from the action. As we say that actions, they speak louder than the words. Some of my students, they just keep planning for FR. They just keep making their plans. Okay, I will start studying after 1 week, after 2 weeks, but they never study at all. So if you are committed, you should start studying. Do not waste your time. So management should be committed to a plan to sell the asset. There is an active program to locate a buyer. Of course, you will be giving proper advertisement and you are trying to locate a buyer. The asset is being actively marketed. If all these conditions are met, only then you can apply IFRS 5. The sale is expected to be completed within 12 months. This is the meaning of highly probable, that after applying IFRS 5, your asset will be sold within 12 months. Of its classification as held for sale, it is unlikely that plan will be significantly changed or withdrawn. Once, basically, this relates to a company, and these big decisions are not made by one manager. These big decisions are made by the BOD. And obviously, once you people have made this decision that we are going to sell XYZ property, plant and equipment, so it is highly unlikely that plan is going to be changed. So it means company is going to sell that asset once they have made this decision. Once an asset is classified as held for sale, it's no longer depreciated. We have already discussed. After applying IFRS 5 on a non-current asset, after applying IFRS 5, no more depreciation, plus non-current asset will be reclassified as current asset in your SOFP. Another point, this non-current asset as held for sale, you have to show under current asset number 1, and there will be a separate line item. You cannot add this non-current asset held for sale with any other current assets. Okay. Plus, it will be measured at lower of carrying amount, and the second is fair value minus cost to sell. Lower of carrying amount, fair value minus cost to sell. Impact is important. Losses recognized on reclassification. For example, assuming carrying amount is 500,000, and let's say the fair value minus cost to sell is 450. So obviously we need to recognize our plant at 450. So we need to recognize the impairment loss of 50,000 under IFRS 5 in this example. Impact, losses recognized on reclassification, but gains are not. This is A. Assuming B, the carrying amount is assuming 500,000 at the time I'm reclassifying my property, plant and equipment to non-current asset held for sale, and let's say the fair value minus cost to sell is 560. In that case, your asset will remain at 5 lakh. So losses are recognized, gains are not when you are applying IFRS 5. Look at this. Gains are not. That is impairment recorded in the statement of profit or loss. Gains are not taken to the revaluation surplus. If there's a gain, you will not recognize that. Okay. Now let's talk about discontinued operations. First of all, student, you should be able to understand the concept of discontinued operation. When I say discontinued operation, you should be thinking, I would say, at a very large scale. Now, what do you mean by at a very large scale? Assuming, let's take an example of ABC company. That's my favorite company. Assuming ABC company is running two different businesses. One business deals in product A, another business deals in product B. But the main thing is ABC deals in two different businesses. One is dealing in product A, another is dealing in product B. Both are the different products, both are in different industries. The markets are different, everything is different. Okay, now let's assume ABC company has decided to sell the entire business of product B. ABC company has decided to sell the entire business of product B. If you have decided this, then I'll say that product B business is your discontinued operation. It means you have to prepare financial statement for the shareholders and you have to let them know the profit which company is enjoying right now. It is actually coming from both the products, from both the businesses. And now we have decided that we'll be selling product B business. So once I'll be preparing the financial statements in such a way that I'm going to technically inform my shareholders that we have decided to sell the business of product B. So they will be in a better position to see what sort of profit will keep coming. Of course, once I'll close the business of product B, then obviously whatever the profit comes in the future, it will be only from product A business. It is necessary, once the criteria is met, then it is necessary to show that product B's operation as discontinued operation. If you don't do that, then it means you are deliberately misleading your shareholders. For example, in 2026, your company has decided that in 27 you will be selling this product B, and it's going, all the discontinued operation criteria is met, and you're not preparing your financial statements by applying IFRS 5. It means you are still informing your shareholders, current and the potential one, that whatever the profit they see right now, that will come in the future as well, and which is not the case. That is why once the criteria is met, you have to show, you have to prepare financial statements showing discontinued operations. Another example, there's a possibility that you have already sold a separate line of business. If you have already sold a separate line of business, so that is also a discontinued operation. And the last example, if parent, now listen this example properly, if parent has acquired a subsidiary, if parent has acquired a subsidiary exclusively for resale, repeat, parent says I have acquired ABC company just for resale. If this is the case, then the entire subsidiary you will have to apply IFRS 5 on that subsidiary, and it will be your discontinued operations. Let's see what IFRS says. A discontinued operation is a component of an entity that either has been disposed of or is classified as held for sale and represent a separate major line of business or a geographical area of operations. Assuming your company is operating in multiple countries, and but now your company has decided, let's say, take an example of any XYZ country. Now your company has decided that we will not be operating in that country from, let's say, from 2026 onwards, or from 2027 onwards. So that is also considered as a discontinued operation. You will have to show that area as a discontinued operation. Is part of a single coordinated plan to dispose of separate major line of business geographical as area of operation. Now, what do you mean by part of a single coordinated plan? Means normally what happens when I'm selling a separate line of business, normally what happens, there will be number of competitors, they will show their interest to buy my business. One of the competitors is going to buy the entire business. Technically, logically, I'll be selling the entire business in a single transaction. Another is a subsidiary acquired exclusively with a view to resale. Discontinued operations are required to be shown separately in the statement of profit and loss in order to help, look at this, what is written, users to predict future performance that is based upon continuing operations. So obviously those operations, they are continue. You will be generating profit on the basis of those operations. They are continued right now, and they will be continued in the future. So it is necessary to show your discontinued operations once the criteria is met. That was a very quick revision of IFRS 5. Now let's see the questions. Just a minute. Okay. And let me tell you one thing, students. I have taken all these questions from Study Hub. Why I have taken all these questions from Study Hub? There's one reason. I would say most of the time what happens, majority of the students, they just stick with one thing, which is a Kaplan kit, which is very good. Majority of the question you can see in your latest Kaplan kit, they are from the past papers. And you are following Kaplan kit, which is perfectly fine, no issue at all. But what happens, more or less every day, you are either practicing new questions from the Kaplan kit, or you might be practicing the previous questions which you have already done from the Kaplan kit. Since majority of the students, they have the interaction with the Kaplan kit, I would say, on a daily basis, which makes them to feel the questions in the Kaplan kit, they are easier than the Study Hub question. And that is not the case. Majority of your Kaplan kit questions, they are from the past papers. But due to that interaction of every day, the frequency of interaction is so high between a student and the Kaplan kit, which makes them feel the questions are very easy. And interaction with the students and the Study Hub is not so frequent. That is why they feel the question they are on Study Hub, they're difficult. But that is not the case at all. Only the problem is frequency of interaction. You just increase your frequency of interaction with the Study Hub questions, you will feel the same which you are feeling in Kaplan kit. Okay. But if any one of you is thinking, sir, I feel the Kaplan kit questions are also very difficult, it means your frequency with the kit interaction is very low. Try to increase it. Give more time to your study, please. Let's start with the very first question. What is the total? Okay, so you need to understand the question as well. They have not given us the choices, no issue at all. What is the total expense to be recognized in respect of this asset in the statement of profit and loss for the year ended. Okay, let's see a question. Okay, one student is saying that is exactly okay. Thank you. Follow this advice. You will be benefited, inshallah. What is the total? Look at the question. What is the total expense to be recognized in respect of this asset in the statement of profit and loss for the year ended December X3? Let's see. On January X0, Beach purchased an asset for 5 lakh. The asset had a useful life 8 years and no residual value. One thing is, whenever you have been given a depreciating asset, an examiner does not mention any depreciation method, then it is always a straight line method for depreciation. Okay. It's a very small thing, but sometimes these small things also confuse when you are sitting in exam. Okay. Because sometimes you might be thinking while sitting in examination hall, which method of depreciation should I use? The answer is when nothing is mentioned, it is always straight line. On July X3, mid of there, the asset was classified as held for sale in accordance with IFRS 5, non-current asset held for sale and discontinued operations. On that date, fair value less cost to sell of disposing of the asset were assessed 2,54,000. Okay, now first of all, the day we are going to apply IFRS 5, let's say on this property, plant and equipment, first we have to calculate a carrying amount on that date. The date is, what is the date? 1st July X3. Let me give it a name. Property, plant and equipment is 5 lakh. Now kindly see this. This plant was purchased on January X0. The useful life is 8 years, fine. And 1st July X3, mid of 2000, you can say mid of X3, the criteria of IFRS 5 is met. So we have to first calculate the net book value. So it means I have to deduct the accumulated depreciation, X0, entire year of X0, entire year of then Y1 or X1, like that, I think X1, then X2, then 6 months of X3. This is going to be 1, 2, 3, and 6 months of X3. So altogether the time period is 3.5 years. So before applying IFRS 5, 3.5 years have passed, which means that if I deduct the accumulated depreciation, just a minute. I'll take 500,000, multiply by 3.5, divided by 8. That will give me the directly. This will give you the directly accumulated depreciation of 3.5 years. 5 lakh. Since there is no residual value, that is why I did not deduct residual value from 5 lakh. Any answer? Okay, answer I'm getting 218750. Thank you. 218750. So 5 lakh minus 218750. We are getting 281,250. Students, this is the carrying amount. Okay, fine. Now let's compare this with the fair value minus cost to sell, which is 254. Fair value minus cost to sell is 2,54,000. First of all, students, after applying IFRS 5, no more depreciation. Second, after applying IFRS 5, you will have to keep your non-current asset held for sale at lower of carrying amount and the fair value minus cost to sell. So we have to bring this property, plant and equipment from 2,81,250 to 254. Logically, under IFRS 5, I have to recognize an impairment loss. Difference of these two, 2,81,250 minus 254. I'm getting impairment loss 27,250, but this 27,250 is not your answer. Examiner did not ask us what is the impairment loss on this asset under IFRS 5. The question is very different. Question says give us the total expense. Total expense in X3. Okay, look at this. On 1st July X3, the criteria of IFRS 5 is met, which means that first 6 months, we in the current year, we have depreciated this property, plant and equipment. Repeat, first 6 months of X3, we have depreciated this asset under IAS 16. It means depreciation expense of first, logically, 6 months. Why I'm putting so much emphasis on first 6 months? Because after applying IFRS 5, no depreciation. It is all before applying IFRS 5. So 5 lakh divided by 8, that will give you the depreciation of the entire year, but we just need a 6 months depreciation. And that 6 months depreciation, don't worry, while calculating the carrying amount, we have already considered. But right now we need to find out that 6 months depreciation so that we can show to our examiner what is the total expense. Students, I'm getting 31,250. I'm getting, okay, great. So here comes the total expense which we will charge to the income statement. Total expense. Two seven two five zero. I'm getting, students, 58,500 because question did not ask how much depreciation will you charge to the P&L. Question did not ask how much impairment loss will you recognize under IFRS 5. The question says give us the total expense. Total expense, then we have got there are two components of total expense. One is, you can say, impairment loss, another is depreciation expense of first 6 months. Because after applying IFRS 5, we know that no depreciation. I hope this is crystal clear to everyone. Should be crystal clear. Let's go ahead. Okay. Yes, but I'm okay. It is definitely, every student does not have the time to come and attend these live crash classes, but I really appreciate if a student they take out some time for these classes. But I'm still okay if those they are watching at least a recording of these crash classes. For an asset to be classified as held for sale, in accordance with IFRS 5, non-current asset held for sale and discontinued operation, the sale of the asset must be highly probable. Yes, we know that. Which two of the following are indicator that sale of the asset is highly probable? Let's see. The asset has been advertised for a sale in, look at this, the asset has been advertised for sale in a trade journal. Yes. If you are advertising, then in trade journal, you will be recording, it's your business statement. You will be recording that, yes, we have started advertising the asset. Okay. What else? A contract with the buyer has been, question. Yes, a contract with the buyer has been signed. Perfect. The fair value of similar asset is 50,000 and management hopes to sell the asset for a profit of 30. If, let me tell you, if you are quoting a price which is not a reasonable price, then I will, that it means IFRS 5 criteria is not met. So what else? Necessary repair, asset needs necessary repair, and after that you will be able to sell. It means your asset is not in an immediate condition to be sold. So logically, A and B, they represents that sale of your asset is highly probable. Let's go for another question. At what amount should the property be recorded in Dune's statement of financial position at 30th September X4? At what amount should the property be reported in Dune's statement of financial position? Let's see. As at 30th September X3, Dune's property in its statement of financial position was property at cost, useful life is 15 years, 45. Accumulated depreciation, they are giving you the information on this date. And you have to show what is the property carrying amount on SOFP on 30th September X4 after 1 year. On 1st April X4, exactly I would say again the mid of there, Dune decided to sell the property. The property was immediately marketed by a property agent at its fair value 42 million. The expected cost to sell have been agreed at 1 million. In September X4, end of the year, market transactions suggested fair value of this property has fallen by 10%. They have not sold the property, no issue at all. First of all, students, the day we have applied IFRS 5, first we need to calculate carrying amount of that asset. 1st April, so they're not making us April fool, please. 1st April X4, April property, and let's work in millions. Property 45 million. Already they have given us the accumulated depreciation of 6, but this accumulated depreciation 6 million is still X3. From 30th September X3 till 1st April X4, we have to deduct the depreciation of 6 months, depreciation expense of current year 6 months, 45, which is the cost of the property divided by the useful life into 6 by 12. So 45 divided by 15 will give us 3, 6 by 12, 1.5. Look at this, 45 minus 6 minus 1.5. The carrying amount is 37.5, but story does not end. Student, this is the carrying amount on 1st April X4. At 1st April X4, the carrying amount of the property is 37.5. Okay, now come here. The property immediately marketed. Look at this. The fair value on this date, 1st April X4, is 42 minus fair value minus the cost to sell, which is 1. So I'm getting 41 million. Now listen to me carefully. At 1st April X4, the property will be measured at 37.5 million. Why? Because the carrying amount is lower than the fair value minus cost to sell on 1st April X4. But question is not asking us what is the property's carrying amount at 1st April X4. They are asking us what is the property's carrying amount on 30th September X4. Means after 6 months, after applying the IFRS 5, in next 6 months have gone, 6 months have passed. Now it is the year end. An examiner is asking us at what value you will show the property on SOFP of Dunes. Plus, examiner has mentioned one more event. Look at this event which happened on end of the year. End of the year, examiner says the fair value of the property has fallen by 10%. Now listen to me carefully. After applying IFRS 5, we have to measure the property, plant and equipment at lower of carrying amount and fair value minus cost to sell. Okay, let's see. At 1st April X4, the property is at 37.5. Now on SOFP date, again you have to compare this 37.5 with fair value minus cost to sell. Whichever is lower, you will keep the property at that value. Now listen, the fair value is 42 million, but on 30th September X4, it is reduced by 10%. So I will take 90% of this. If we take 90% of this, students, I'm getting 37.8. 37.8 is a fair value minus cost to sell. So I'm getting 36.8. Now listen. The carrying amount in our books is 37.5, but on 30th September X4, fair value minus cost to sell is now lower than the carrying amount. So I will keep my property in my SOFP at 36.8 million. C is the answer. And one more thing. Some of the students, they might be thinking, sir, the question says, at what amount should the property be reported in Dune's statement of financial position on this date? At 30th September X4, the property has not been sold. Some of the students, they might start thinking, sir, year end has come. Dune did not sell this property. So do we still apply IFRS 5 because we have just revised IFRS 5, and IFRS 5 says after applying IFRS 5, your asset should be sold within 12 months. That is actually one of the meanings of your sale of asset is highly probable. If you read this question, the day we have applied IFRS 5, from that day till the year end, only 6 months have passed, not more than 12 months. IFRS 5 we applied on 1st April X4, which is mid of the year. The day we applied IFRS 5, from that day till the year end, only 6 months have gone. And within 6 months, if you did not sell, it's okay. The issue arises if 12 months have passed and you did not sell the property. Then obviously, if there is no exception, you will come take out your property from IFRS 5 and bring it to the normal IAS, but that is not in FR syllabus. This is what you study in SBR. But right now, I was just giving you an idea. Some of the students, they have very good understanding on IAS and IFRS. They might, stop here for a while. That a student might start thinking the year end has come, property they did not sell, but still we are applying IFRS 5. The answer is the day we applied IFRS 5, from that day till the year end, only 6 months have passed, not more than 12 months. Okay. Any question? It is helpful. Thank you. Okay, students. IAS 37. Students, I'll be giving you the revision of IAS 37 through directly questions. That is considered a bit easier than IFRS 5, I would say. Again, I've taken all these questions. In fact, in crash classes, I've decided that I'll be taking all the questions from Study Hub. In fact, after just one more class, I'll be conducting an entire class. There will be an entire class on consolidation, and we'll take consolidation questions also from Study Hub. In fact, all the homeworks which we have given with answers in your WhatsApp group, they are from Study Hub. Kindly try to attempt those questions. They are given to you as your homework. This is chapter number 15, IAS 37, provision, contingent liabilities and contingent assets. Identify by clicking. Just a minute. Okay, any question? Noted. Thank you. Identify by clicking the relevant box in the table below. Okay. Right now we did not make any table just to save time. Whether each of the following statements about provisions, contingencies, and events after the reporting period are correct or incorrect. Let's see. It says correct, incorrect. Number one is a company expecting future operating losses should make provision for those losses as soon as it becomes probable that they will be incurred. Now listen carefully. A company expecting future operating losses. Stop. It is categorically, clearly mentioned in IAS 37 that you cannot make a provision for future operating losses. Now, let me first explain what is the meaning of future operating losses. Then I'll come to this again. Future operating losses means that assuming we are running ABC company, something went wrong in the entire economy, and we know that in the future when we will be running ABC company, we'll be facing losses. We are not going to get the same demand which we were getting earlier. So obviously the operational cost will be higher. The revenue which we'll be generating, that is going to be very low. So we'll bear the losses. That is future operating losses. Let me give you the example. Right now, of course, things are not good in every country. There are some of the countries, they are heavily depending on tourism, but due to, I would say, uncertain situations, they might not be able to attract the same number of tourists which they were attracting earlier. We pray and we hope they should be getting the same number of tourists, so that their economy should be on the proper track record. but apparently, which we can see that they may not be able to get the same number of tourists. Now what happens? If I am running a hotel and I know that something went wrong in the economy and we will not be able to get the same number of, I would say, guests, same number of tourists which we had previously, but still I cannot shut down my business. I'll be still running my operations. I'll be bearing all the overheads, everything. So logically, my operational cost will be more than what revenue I'll be generating. That is operating loss. But IAS 37 clearly says you cannot make a provision for operating losses. In fact, operating losses is one of the indicators of an impairment loss. But you cannot make provision. So it is incorrect. Let me write here. Details of all adjusting events after the reporting period must be disclosed. No, 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 no. It says adjusting events. Adjusting events should be adjusted rather than disclose. You are saying adjusting event. Why would I disclose? I'll be properly adjusting it. Correct, incorrect. A contingent asset must be recognized as an asset in the statement of financial position if it is probable that it will result in inflow. If it is probable, then you should be disclosing it. You are not supposed to recognize that as an asset. Incorrect. Contingent liabilities must be treated as actual liabilities and recognized when it is probable that they will arise if they can be measured with reliability. That is correct. In fact, if this happens, then your contingent liability is no more a contingent liability. It becomes a liability. It becomes a provision. Read it again. Contingent liability must be treated as actual liabilities and recognized, but when it is probable means more than 50% chances are there will be an outflow of economic benefits. So you will be recognizing this as a provision. So basically the last one is correct, but I would consider this question as a very good question. Let's see the next one. Which two of the following statement about contingent asset? Which two of the following statement about contingent asset and contingent liabilities are true according to IAS 37, contingent liabilities and contingent asset? A contingent asset should be disclosed in a note if an inflow of economic benefit is probable true. If it is more than 50% chances you will be getting an inflow from that contingent asset, you have to disclose. A contingent liability should be disclosed in a note regardless of the probability of transferring. No, false. It's a contingent liability you will have to disclose regardless of any probability. What if the chances are only 5 to 10%? I will do nothing. I will do nothing. No disclosure is required for contingent liability if it is less than probable that a transfer of economic benefit to settle will be, again I would say it's false. Why false? Look at this. No disclosure is required for a contingent liability if it is less than probable. Actually, contingent liabilities percentage probability is less than probable, means less than 50%. Then disclosure is required. You need to disclose. If circumstances relating to a contingent asset change and an inflow of economic benefit becomes virtually certain, means 95% plus, an asset should be recognized true. Logically, then it is your asset rather than a contingent asset. Just if I give you the example about point D, I'm just assuming, okay? Don't take it seriously. Assuming Mr. Y, the name of a character who lives in, let's say, Uganda, and let's say Mr. Y is having around 5 to 6 brothers and sisters. But assuming Mr. Y does not perform good at home, he's not good at study, his professional life is also not going so good. But after facing such a, I would say, rough time and facing criticism, from different people, Mr. Y has realized now this is the time I have to focus on my study, I have to focus on my professional life. Now I have to grow and I have to prove to the entire world, if not at least to my family members, at least to the circle of people whom I'm facing almost every day, that I can achieve something. If within next 2 to 3 years, assuming Mr. Y completes his entire study and in his professional life, he has achieved something remarkable, which nobody was in fact expecting from Mr. Y. So I would say after all this, Mr. Y will become, I would say, an apple of everyone's eyes. Everyone is going to like Mr. Y if he achieves all these things. So this is happening in part D. Something was my contingent asset, then it became my asset. So now let's see the next thing. Match how the fine and damage. Actually, there are two columns. One is fine and another is damages. Match how the fine and damages should be treated in the financial statements. Shortly before the year end of its financial year, XYZ was found guilty of contravening employment laws. The tribunal confirmed that a monetary fine will be levied on the company, which means the monetary liability is imposed on your company. You will have to pay. So fine will be levied on the company, means monetary liability will be imposed on your company. XYZ is also in the process of claiming damages against former director. The company's lawyers believe there is an 80% chance that XYZ win the case. If you are going to win the case, there are 80% chances. Still, it is a contingent asset and you have to disclose. You cannot recognize as an asset. If you read the last part, XYZ company is also in the process of claiming damages against a former director. The company's lawyers believe that there is an 80% chance that XYZ company will win. 80% chance you have to disclose. Find the select. So here it's going to be disclosure. And look at this. Shortly before the end, financial XYZ company was found guilty. The company was found guilty. You have to recognize a provision. Means a liability. So you need to recognize a provision because the company is found guilty. When it comes to damages, logically you have to just disclose because it is your contingent asset. There are 80% chances you are going to win. So it's your contingent asset. Becomes an asset once the percentage of winning becomes 95% plus more than 95%. Then we say virtually certain. Let's see which two of the following should Tynan recognize a liability as at 30th September X4 Tynan's year end. Which two of the following should Tynan recognize a liability? The signing of a non-cancelable contract in September X4 to supply goods in the following year on which, due to a pricing error, a loss will be made. If you recall IAS 37, they're giving you a hint towards an onerous contract. Students, if you recall, onerous contract is a contract where cost of fulfilling the contract is more than the benefits. But you have to fulfill the contract. You have got no other way around. You cannot get rid of this contract without fulfilling it. So either you should fulfill the contract, if not, then pay the damages. So simply, in any case, you will have to recognize a liability. But if this scenario is of an onerous contract, and I would say majority of the student, they will not be able to, after reading part A, it is, I would say, majority of the student will not be able to identify that they are talking about onerous contract. But at least you should know after reading this that yes, we need to recognize a liability. So this is your liability. But I have given you the exact area. I've identified for you the exact area of IAS 37. Here examiner is talking about an onerous contract. The cost of a reorganization which was approved by the board in August X4 but has not yet been implemented communicated to the interested parties, you cannot recognize this as the second one is cannot be your liability, cannot be your provision. Why? Student, if you recall, when do we recognize restructuring provision? When two conditions are met. One, there has to be a detailed formal plan approved by BOD. Second, you need to communicate to the stakeholders they will be affected by that plan. And the key stakeholders are, let's say, those employees, they will be affected, they're going to lose a job. Those suppliers that whom XYZ material you are purchasing after reorganization, restructuring, you, let's say you are not going to buy that material. And third, I would say your customers. There's a possibility I'm delivering product A, and after restructuring, I might not be delivering that product. So you need to communicate to the key stakeholders. Here, the communication part is missing, and they have not implemented as well, because let me tell you one thing. If there's a detailed formal plan approved by the BOD, but company did not announce to anyone, but they have started implementing the plan. Actually, if you start implementing the plan, it is technically a sort of communication. Still, you can make the provision. Because if I'm working as an employee, okay, let's say I'm working in ABC company, and within that ABC company, the department whom I run, that department actually deals with product B. And I just, within 1 month, I realized something new is happening in my company. Every day the new people are coming and they're talking about, okay, we want to buy this entire business of B. So it means they have started, it looks they have started implementing restructuring plan. So even there's no communication, but after a detailed formal plan, if they have started implementing the plan, still you can make the provision. But they have not implemented, they have not communicated, I cannot make a provision. An amount of deferred tax relating to a gain on the revaluation of the property during the current year. Tynan has no intention of selling the property in the foreseeable future. Now listen, either you have the intention to sell the property or not, due to revaluation, whatever the deferred tax comes, you have to recognize. Let me explain. Assuming carrying amount of the land is 7 lakh, including a revaluation surplus of 1 lakh. Tax base, we know that taxation authorities do not accept revaluation. For taxation authorities, the tax base of land is the original cost. Assuming original cost of the land is 6 lakh. If the original cost of the land is 6 lakh and the carrying amount is 7, it means 1 lakh. Third column is temporary difference, but this 1 lakh difference, it is a taxable difference, we know that, but logically this taxable difference is coming because of revaluation surplus. Assuming the tax rate is 30%, debit and credit, the entry will be revaluation surplus slash OCI. I will debit by 30,000, because if you take 30% of 1 lakh, it is 30,000. I have to recognize a deferred tax liability of 30,000. No matter the company wants to sell that land or not, it has nothing to do with this. If you have recognized a revaluation surplus, and revaluation surplus will create a deferred tax liability, and you have to recognize. But you should know that one thing regarding IAS 12, when due to revaluation surplus, we need to recognize a deferred tax liability, then we have to charge that to revaluation surplus. You can see that we did not debit any income statement item. We have debited our revaluation surplus other comprehensive income. But you have to recognize a liability. The balance on the warranty provision which relates to the product for which there are no outstanding claims and whose warranties had been expired. If there's no outstanding claim, warranties have been expired, why would I recognize a provision? It's not a liability. So logically, A and C, they represent the situation where you need to recognize the liability. Let's see next question. Look at the question nicely. Requirement. What total provision? They're not asking provision. They're asking total provision. Extraction plus dismantling. Now stop. If you recall the concept of dismantling, for example, I have installed a property plant and equipment, and at the useful life of that property plant and equipment, the government, they have informed me, or I have the policy, whenever we invest in such a property plant and equipment, then at the end of useful life, we have the history of dismantling it. Either it can be a legal obligation, or it can be a constructive obligation. In both the cases, step one, I'll be recognizing present value of dismantling cost, and the double entry will be property plant and equipment debit, provision credit by, I will take the which amount? Present value amount. After initially you have recognized the provision of dismantling cost, then that provision will increase due to unwinding of discount. And the double entry of unwinding of discount is finance cost debit, provision credit. Should explorer report in his statement of financial position SOFP on this date? Let's see. On October X3, I would say start of there. Explorer comments drilling off for oil from an undersea oil field. Okay. The extraction of oil caused damage to the seabed, which has reached restorative cost, ignoring discounting $10,000 per million barrel of oil extracted. Wow. Per million barrel, you will be bearing $10,000. Explorer extracted 250 million barrels of oil in this year. Okay. Explorer is also required to dismantle the drilling equipment at the end of 5-year license. This has an estimated cost of 30 million on 30th September X8. Explorer cost of capital is 8% per annum. For $1, it has a present value of 68 cent, means 0.68 in 5 years time. Now listen, everything is in million. Due to extraction, the cost which I have to bear is $10,000. It is per million. Now, first of all, $10,000, if I divide this with million, so let's see per million what will be the cost. Why I'm doing this, I'll tell you, because the entire data they have given me, it is in million. I'll get 0.0. This is 0.0 is $0.01 is per million. Per million extraction of barrel. How many barrel they have extracted? 250 million. Multiply by 250. I'm getting 2.5 million. So provision relating to extraction activity only is 2.5 million, but this is not the answer. They have asked us the total provision. This is one of them. Second, let's talk about the dismantling one. Look at this. Present value of dismantling cost. Dismantling cost is going to be 30 million in 5 years time, and the discount rate in 5 years time is 0.68. 13 to 0.68. I'm getting 20.4. Now listen. Day 1 means 1st October X3, the double entry of dismantling cost is property, plant and equipment debit by 20.4 million and property or provision credit by 20.4 million. But examiner is asking us the total provision on 30th September X3. It means this is all happening on 1st October X3. 30th September X4, due to unwinding of discount, the value of the provision of dismantling will increase. Unwinding of discount. Simply take, let me write this properly. Students, simply take 20.4, multiply by the discount rate which they have given you, I think 8%. If you ask me what is the double entry of unwinding, I'll say finance cost debit, provision credit. 20 point, and let me tell you one thing. The good part is most of the time your examiner does not ask you to prepare journal entries. This is what, while studying, we keep saying debit this, credit this, just to develop your more understanding. That's it. But it's better if you have the good idea about double entries. Students, I'm getting 1.632. So here comes the total provision. 2.5 plus 20.4 plus 1.632. Students, I'm getting 24.532 million. And let me tell you one thing. If you do not get the exact answer, then obviously go to the closest one. 25. I'll go for part D. Logically, the answer is B, 24.5. Let's see one more. Okay, at what amount will the provision for restoration cost be measured in Fluid Company's statement of financial position on this date? They're again asking more or less the same thing. Provision for restoration cost. Again, you will be first calculating present value, then unwinding of discount. Fluid Company undertakes drilling activities and has a widely published environmental policy. Stop. I think when we were doing the previous question, I did mention there's a possibility we have a policy or past practice of bearing the dismantling cost that will create a constructive obligation on your organization. And the second, there's a possibility it is required by the government. There's a legal obligation, I have to bear the dismantling cost. Either it is a legal obligation to bear the dismantling cost, or it is a constructive obligation. Obviously, legal obligation and constructive obligation in legal terms, they are different. But we are following accounting. As far as accounting is concerned, for your legal obligation and constructive obligation, accounting is same. Same thing applies on restoration cost. And here we can see that this company, if they are going to bear restoration cost, they will be bearing the restoration cost due to their constructive obligation. Because if you have past practice of doing XYZ activity, obviously whoever will come to know about your past practices, that will create valid expectation on that person, which ultimately creates constructive obligation on the company. Assuming if XYZ students joins my college, Abil School of Accountancy, for any paper, we claim that we will conduct your live revision classes, we will give you the revision, topical revision, you will be getting the question-based revision as well. So it means whoever, coming to us after listening all this, it means that person is coming to us with all these expectations. So if student is coming to us with all these expectations, it means we have the constructive obligation to fulfill that. Okay, come here. Fluid Company undertakes drilling activities, has a widely published environmental policy stating that it will incur cost to restore land to its original condition once the drilling activities have been completed. Okay. Drilling commenced on a particular piece of land on July X8. Mid of there. At this time, Fluid Company estimates that it would cost 3 million to restore the land. Drilling was completed in 5 years' time. Fluid Company's cost of capital 7% and rate is this. Look at this present value of restoration cost. I'll take 3 million into 0.713, and this is we are calculating on 1st July X8. 3 million to 0.713. Oh, I got something wrong. Okay, actually I'm working in million. 2 point. Now student, listen. We have calculated the present value of the restoration cost exactly mid of there. So from 1st July X8 till December X8, the time period is 6 months. So unwinding of discount will come, but only for 6 months, which means that previously in question 5, unwinding of discount was for the 12 months, but here it is only 6 months, because from 1st July X8 till December X8, it is a 6 months period. Unwinding of discount, the double entry is finance cost debit, provision credit. Unwinding of we'll take 2.139 and the rate is 7%, but this time 6 by 12. So I'm getting 0.074865. Students, I'm getting 2.2138 something. Again, if you don't, okay, we have the same answer in fact. 40 is the answer. Okay. Okay, students, let's go to IAS 32, which is the last IAS of today's class. As I already told you, IAS 33, inshallah, you will see the questions on IAS 33 in the coming class. Don't worry at all. IAS 32, which deals with financial instrument. Basically, in IAS 32, you should know a very good concept. You should be having a very good concept of IA financial asset. Should be having a very good understanding of financial asset. Second, financial liability. Third, I would say compound financial instrument. Let me start from third, compound financial instrument. Compound financial instrument, another name for the compound financial instrument is a hybrid instrument. Compound financial instrument is an instrument which has two characteristics. Characteristics of equity as well as characteristics of debt. According to IAS 32, the company who has issued convertible bond, a compound financial instrument, it is your duty, it is your responsibility to separate that compound financial instrument into debt component and equity component. And once you have calculated the equity component does not change. Second, of course, the financial liability component slowly and gradually it will keep increasing due to unwinding of discount. How to separate, how to split a compound financial instrument? Very simple. According to IAS 32, just calculate one component of compound financial instrument, deduct that component from the total, balancing figure will be the second component. The question is how to calculate one of the components. The answer in the guideline, interestingly, is given by IAS 32. IAS 32 says it is generally easy to calculate financial liability component because financial liability is equal to present value of all future cash flows. So in case of, I would say, convertible debt, we know that how much interest every year my company will be paying and what amount we'll be paying at maturity. So all we need is just calculate the present value of all future cash flows. The main thing is for calculating the present value of all future cash flows, the discount rate which you will be using, that discount rate will be the market interest rate on debentures without the conversion option. Because I want to calculate a pure debt, pure liability. That is why I need a discount rate which does not have any conversion option. And one more thing which you should know, that generally on convertible debt, interest rate will be lower, and on non-convertible debt, there is a technical name for the non-convertible debt. That technical name is a straight debt. On a straight debt, interest rate will be higher. So if ABC company issues convertible bond, they will be paying lower cash interest on the convertible bond as compared to if they issue, I would say, straight debt. Straight debt means without conversion option. Now let's talk about, I would say, financial asset. Simply, there are a number of examples of financial asset. Financial asset is not only one thing. Like cash is your financial asset. If you have a contractual right to receive cash, for example, your accounts receivable is your financial asset. If you have invested in XYZ company's shares, equity instrument of another company is your financial asset. If you have invested in the debenture of any company, for you, it is a financial asset. In fact, if you are the buyer of a call option or a put option, call option means right to buy, put option means right to sell. If you are a buyer of either call option, put option, or even both, they are financial asset for you because they give you the right to exchange the financial instrument when things are favorable for you. Call option means right to buy. I will only exercise the right to buy call option when things are favorable for me. So if you are you just need to remember one point. If I am a buyer of a call option or a put option, for me, they are financial assets. Now think for the financial liability, which is exactly the opposite of financial asset. Like I have the contractual obligation to deliver cash, like accounts payable is a financial liability. Bank loan is a financial liability. because we have the contractual obligation to deliver cash. Another thing, if ABC company is if ABC company is the buyer of call option or a put option, for ABC company those options are financial asset. If XYZ company is the seller of those options, then for XYZ company, call or put option becomes financial liability. So you have to think exactly opposite of financial asset, it becomes your financial liability. Now let's come here. I've just given you the quick idea. How should convertible debt be classified in accordance with IAS 32? Simply, debt component should be separate, equity component should be separate as either a liability or equity based on valuation. No. A separate liability and equity component basing the liability element on the perfect. And equity in its entirety as a liability. No. Let's see. I want you to read this. I think you can very easily answer. Which of the following is a financial asset in accordance with IAS 32? Financial instrument presentation. A holding of equity instrument, yes. When you are having shares, so ordinary shares of another company, it is for you financial asset. A contract to exchange financial instrument with another entity under conditions which are potentially favorable, financial asset, like you are a buyer of call option, put option, they are financial asset for you. A contract to exchange financial instrument with another entity under conditions which are potentially favorable. Okay. A contract to exchange financial instrument with another entity under conditions which are potentially, this is financial liability. But we are here to find out financial asset. Cash is your financial asset. Logically, this is my financial asset, this is my financial asset, this is my financial asset. 1, 2, 4. Okay, student, let's deal with the last question of today. Wow. At what amount should the equity component of the bonds to be recognized? To the nearest 00, nearest 100. At what amount should the equity component? Fine, let's see. My solo. Apologies if the pronunciation is wrong. My solo issued 3,000 convertible bond at $100. On 1st January X6, redeemable in 3 years. Interest is payable in arrears. Every year we pay the interest, which is 6%. Market rate of interest at the date of issue was 8%. And I have already given you the idea. Market interest rate on non-convertible bond will be higher than the market interest rate on convertible bond. Basically, why convertible bond? They have a lower interest rate, because if my company issues convertible bond, it means I'm giving an opportunity to the buyer of convertible bond that at maturity, it is up to the buyer of convertible bond. It is up to the investor of the convertible bond at maturity. You can ask for the redemption amount, or even you can go for the conversion. You can convert convertible bond to ordinary shares. So obviously investor will opt the option which is more beneficial for the investor. So if my company is putting you and giving you something which can benefit you, so what ultimate benefit, what I'm going to get, what sort of benefit my company will get? Why would I give you an option that at maturity, whichever suits you, follow that? So ultimately I should be getting a benefit. So benefit to my company is I'll be paying interest which will be lower than a non-convertible bond. Present value they have given at 6% and 8%. So 8 is relevant for us, 6% discount rate is not relevant. First of all, 3,000 into 100, it will become 3 lakh if I'm not wrong. So 6% of 3 lakh is 18,000. Listen, here I'll be paying 18,000 year 1, year 2. In the last year, we'll be paying 18,000 plus the principal amount, so 3 lakh 18,000. Let's use the calculator. 18,000 into 0.926. Students, I am getting 1,668. Okay, 18,000 into 0.857. Students, I'm getting 15,426. 3,18,000 into 0.794. I'm getting 2,52,492. Total of all these present value is equal to financial liability, is equal to the debt component. And from total proceed of convertible bond, you deduct the debt component, balancing figure will be your equity component. 1,668 plus 15,426 plus 252, 492. Students, I'm getting 2,84,586. This is my debt component. But they're not asking debt component, they're actually asking equity component. So here comes the equity component, which is going to be the balancing figure. Total proceed from convertible bond is 3 lakh minus the debt component is 2,84,586. 300,000 minus 284,586. I'm getting 15,414. Again, if we do not, they are also saying go to the nearest 100. Let's see. Students, see, Charlie is the answer. So, dear students, that is all about today's class. In today's class, actually, we revised through our IFRS and through different questions. IFRS 5, IAS 37, IAS 32. In the coming class, I will try my best to complete all the remaining IAS and IFRS so that we can have a one complete, after that we can have a complete one class on consolidation. After consolidation, we can have at least one complete class on ratio analysis, which is interpretation of financial statements. And this is something which you people are getting. It is something additional than the pre-recorded classes. Let me tell you one thing. Plus, students, my WhatsApp support is available to you till the last day of exam. So wherever you get stuck, don't worry at all. Your teacher is there, inshallah, to help you. So thank you very much. And I really appreciate that you people have taken out time from your busy schedule to attend these live classes. Thank you very much. Hope to see you and others in the coming class as well. Thank you. And kindly do give the feedback in your relevant WhatsApp groups about today's class.